The United States may have avoided defaulting on its debts with a political agreement to increase the amount of money it can borrow, along with promises to spend less. But the financial markets remain sceptical, even as the politicians continue to bicker about tax hikes and spending cuts. Washington already owes $14.3 trillion. By raising the debt ceiling, it can sell government bonds worth another $2.1 trillion to pay its bills. To reach the agreement, President Obama had to accept deeper spending cuts than he wanted, though he did manage to prevent cuts to areas like medical programs for the poor and elderly for the moment. Job-creating investment in education and research will also be preserved. The big problem is that so far there's only agreement on $917 billion worth of savings over the next 10 years. Another $1.5 trillion will have to be agreed by a congressional commission in November. The financial experts at the ratings agencies have been going through the details of the deal, and the fear is that they will decide it doesn't add up, so they will downgrade Washington's AAA status. The debt deal also does nothing to boost the fragile US economy. It nearly stalled in the first half of this year and shows no signs of picking up. Having managed reasonably respectable growth of 3.1% and then 2.6% at the end of 2010, the US economy came close to stalling between January and March and grew just 1.3% in the second quarter. And for the moment, there is no talk in Washington of new stimulus measures to change that situation, leading to fears the US could slip back into recession.